Hello, everyone. Welcome to the Final Bar. It's Thursday, August 11th. Today, we have a great guest, Mark Newton from FundStrat Global Advisors in New York. We're going to talk about what appeared to be a rager of a rally day, a full risk-on day in the first, hour of trading, and then gives all of that back and more. The NASDAQ actually finishing about 0.2% in the red, the S&P just below flat. We'll talk about what is happening as the S&P, as the NASDAQ, as the Russell hitting key resistance levels. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. Technical analysis is designed to help you quantify investor behavior, to better appreciate market history and better understand market dynamics. And I feel like 2022 has been very much a history lesson in the markets. It's caused me to look back at previous bear market phases, to really track the trajectory of previous bear market rallies and focus on periods like we're seeing right now, which is a beaten down market with bombed out sentiment that all of a sudden turns, and relatively quickly you see a change in leadership, very much a change in character, and certainly a change in dynamics. And this is a tricky time. It's a challenging time for sure, because I feel like bulls and bears all feel validated in some way, right? We can all point to some evidence that seems to back up the overall thesis. At the end of the day, it's all about looking and reflecting and taking a weight of the evidence approach, I would argue. We'll see what sort of evidence we can look at together using the charts on our program today. We have a great guest today, by the way. Mark Newton is one of the best in terms of really illustrating some of the themes from a technical perspective. Other guests through the remainder of this week, we have JC. Actually, sorry, this is going into next week. On Tuesday, we have JC O'Hara from MKM Partners. We missed him this week. We have him rescheduled for next Tuesday, the 16th. On Wednesday, one of the best contrarians, David Hunter, will be joining us on the show. And then on Thursday, the 18th, Jeff Huge, who's the founder of JWH Investments in Minneapolis, one of the best pure stock pickers that we have on the show. Let's continue on today's show, talk about our market recap. As I mentioned in the introduction, quite an interesting day. Yesterday finished at the highs of the day, closing above 4,200. This morning, it felt like an acceleration. It felt like people were stomping on the accelerator. That fizzled out very quickly, and the remainder of the day was actually retracing those gains, and in the end, finishing a little bit in the red. Let's look at the charts and see how things played out. The S&P essentially flat for the day, closing still just above 4,200, but just barely. This was basically, I feel like days like this reinforce the value of key levels. In 4,200, we've been talking about for quite some time now, for months, as the market has been in a downtrend, started to revert higher. 4,150 to 4,200 has been our range, and we are absolutely there. The NASDAQ composite actually finished down about 0.6%, and the Dow essentially flat along with the S&P 500. The VIX is bouncing higher, just above 20. The VIX was below 20 earlier this week for the first time. Well, actually, one of the few observations in 2022 where the VIX was below 20. There might be a message there. We'll look at the chart of the VIX here in a short while and see what we can uncover there. Elsewhere in the markets, mid caps and small caps both up today, and energy and financials were the two strongest sectors. That usually makes sense because there's a little more of a weight in those sectors in those mid, particularly the mid cap index. Interest rates overall went higher, particularly the longer end of the curve, with the 10-year yield around 289, 30-year yield, long bond yield moving even higher above 3%. This is pretty much down at 3%. Just in the last couple of days, bouncing a little bit to the upside. Had my guests earlier this week, Ari Wald, we were talking about 10-year yield. That continues to be an important chart. And I know, talking to Mark Newton before the show today, I think we might revisit the 10-year in a little bit. So I'll leave the discussion for there. The dollar index, by the way, flat using the UUP, is about the same as where we were yesterday. By the way, on the dollar, I was talking with Blake Morrow from Forex Analytics. He's our friend over there. And I went on his show, did a little interview that'll air the beginning of next week on their Trader Summit portal. And we were talking about a number of things, but they focus a lot on the currency markets. We talked about that strong dollar environment in the first half of 2022 dramatically changing. And if you think about what's different from June to now versus what happened up through the end of June, I would say the dollar is a big part of that. Interest rates certainly related to that as well, but the dollar being so strong and then pulling back, a key theme to pay attention to. Gold and silver down today, not by much for gold, about 0.25% using the GLD. The rest of the commodity space higher, and as I mentioned, energy did pretty well today relative to the other equity sectors. Cryptocurrencies mixed, to be honest with you, but the two big ones we tend to focus on, Bitcoin and Ether, both bouncing higher a little bit. Now, you've had a nice run on some of these areas. Bitcoin is accelerated to the upside, touching almost 25,000 earlier today, settled back a bit, still above 24,000, and Ether right around 1,900. Now, these are key levels, and I think Ether around 2,000 is a really interesting level to pay attention to. Big round numbers on some of those cryptocurrencies have ended up being a fairly meaningful time to reflect and identify whether there's enough to continue through those points. There's often been a turn at key levels like 1,000, 2,000, and so forth. Let's check in on a chart of the S&P 500 now that we've sort of set the stage on what's happened. A fascinating day. And I feel like many times on the show, I try to make the argument that we're at a pivotal point. No, I don't always, because sometimes it's just sort of business as usual. The trend is in place. The movement of the day is in line with the larger trend, and it's just sort of a continuation sort of day. Today was a really interesting one. Yesterday, we gapped higher and closed above 4,200 for the first time since early May. That's significant because this blue shaded area that we've talked about is that 4,150 to 4,200 range. That's where we topped out in June. This is all about, can we eclipse those highs or not? I have to remind you, back here in March, right? February, we had a high around 4,600. In March, we got above there for about 1 or 2 days, and that was the end of this bear market rally, a move that not only tested the February and March lows, but made new lows going in through the end of April and into May. Now, all of a sudden, we have a very similar situation. We are at the end of March. Now, there are some differences that we could talk about for sure, right? I mean, June, July, August has been very different than February, March, April, right? In a lot of ways, in terms of the Fed, we've gotten used to a lot more rate hikes, and interest rates obviously have gone a lot further, now coming down quite a bit. So certainly there's some differences, but from a technical perspective, we've retraced back to the previous swing high and are attempting to get above there. That's where things stalled out before. And I think from a behavioral perspective, a lot of people are seeing that and recognizing that we're looking very similar to what we did right there before we started to really accelerate to the downside. Getting above a resistance level is important. I always talk about a follow-through day. In the show yesterday, I don't remember if I said this, but I wish I did. If I didn't, we talked about nice move above 4,200, nice close above 4,200. Do we have follow-through? I don't think you could describe today as a follow-through day. Earlier in the morning, when it felt like we were accelerating, we got above 4,250. As I'm sketching out early ideas of what to talk about in the show, I'm thinking, all right, we have to talk about follow-throughs. I have to give the green light to much further upside potential. We'll talk about risk on. I don't know if that's the feeling I have by the end of the day. A lot of the stocks that had early gains gave them all back and more. And now we're right back where we were yesterday. So I don't think we've had enough of a follow-through, but that's certainly what I would look for tomorrow and absolutely going into next week. Just to finish off our market recap, let's look at sectors very quickly. Then I do want to show a chart of the VIX to talk about that as well. Energy and everything else was sort of the story today from a sector perspective. Energy, the XLE up 3.5%, followed by financials up just over 1%. Then it was industrials and materials. So the MEI stocks, which are materials, energy, industrials, is sort of a late cyclical sectors. Financials in there as well. And so it was very much a value over growth kind of feel to the day. As a matter of fact, the value indexes, value ETFs probably finished in the green today, I would imagine. I haven't looked at them, but just looking at the sector movements, that would make a ton of sense to me. On the downside, you had healthcare down about 0.2%, followed by consumer discretionary real estate. So no real drops in any of these sectors. That's a token drop. But remember, you have to think about the trajectory of this day, the short-term sentiment really shifting very quickly and rotating to the downside. I've threatened a chart of the VIX, and I just want to go there just to finish off our segment. This is the chart of the VIX that I usually refer to, and I did a video on my YouTube channel, which is called Market Misbehavior. I think this was last week's where I talked in a good amount of detail about the VIX. So if what I'm about to tell you does not make sense, please go there and study a little more about the idea of volatility. But Well, we're talking about the VIX. It's all about what I would describe as volatility regime. Volatility in terms of the VIX usually settles into a particular range for about 6 to 9 months. And then you have this shift, right? Sort of a change from the volatility sort of regime we've been in, meaning a certain range, things change, right? And something's different. So once a range is established and then we break out of the range, that is your warning that things are different. So for example, right, in late 2020, early 2021, in March, you finally broke below 20 for the first time since the February 2020 high. That was a sign that things were a little bit different. And that was really after the market broke out of a consolidation range in the fourth quarter of the previous year, really set the stage for a period of low volatility and a nice sustained bull market. Remember, we had pullbacks, minimal pullbacks. I mean, 5% was unheard of in that period. It was just a nice, slow and steady gainer. Then in November, December, January, look how we finally spiked above 25. We sort of exited that range. That sort of told you that there's going to be a new volatility range. This has entered into the choppy, much more volatile 2022. Overall, obviously, a much more bearish phase to most of this year. Now, all of a sudden, we've had the rally up to S&P 4,200. The VIX has gotten down to 20. This is why I think this is an important chart to watch. Now, do we have enough momentum in stocks? Do we break above 4,200? And does the VIX get below 20? And if so, I think the argument would be we're in a different regime and we're most likely entering something a little more like mid-2021, which was this nice recovery or sort of continuing the rally that had led to that point. If, however, we bounce from here, that is pretty negative for stocks. That tells you to brace for a bit of a risk on in the short term and a potential retest of the lows. But watching the VIX and what happens with volatility could be a really interesting precursor to that move. Let's take a quick break. We'll be back with today's guest, Mark Newton. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. A couple quick announcements before we get to today's guest, Mark Newton. First off, we welcome your questions. We had a great mailbag segment on Tuesday, by the way. We had a lot of really good questions from you guys. We're going to do another mailbag on tomorrow's show on Friday. We'd love to feature one of your questions live on the air. Our email is the best way to get a hold of us. That's thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. And we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. All of my previous conversations with some really knowledgeable guests like Mark Newton and Ari Wald and JC O'Hara and Mark Chaikin and many others are all available on demand. Also, some fantastic mid-year market outlook specials, which I would encourage you to review, from Martin Pring, Larry Williams, a whole group for charting the second half, which was our Stock Charts mid-year outlook. That's all on demand at StockChartsTV.com. Or on your mobile device, just search for Stock Charts TV on demand. I want to welcome on today's guest, Mark Newton. Mark's been a frequent guest on the show, and for a very good reason. He's the Global Head of Technical Strategy at FundStrat Global in New York. Mark, good to see you and welcome back.
Thank you, Dave. It's great to be back.
So as we're looking at this markets, I've been mentioning in the last couple of days, it feels like we're at this critical juncture, right? 2022 has been a raging bear market. And then all of a sudden, June through August has been a very different feel. We're starting with your chart of the S&P 500. How are you seeing the markets here?
Well, in the near term, I think there are some reasons to believe that we might stall out in the short run. I've been on the record as saying that, the first half of the year would see a decline down to 38.15 into June, and then we'd rebound the back half of the year, specifically based on a lot of cycles that I track. Near term, though, there are some reasons to think we stall out. S&P has recovered 50% of the entire decline from January down to June. Initially, that's important. I would also add that it's right close to a 38.2% Fibonacci time retracement for this whole move. We declined in about 23 weeks' time, which is 164 calendar days to you and me. Now the advance says it'll be equal as of really Tuesday of next week. So we're really, really close, where we're going to retrace 50% in time, or 50% in price, 38.2 in time. that lines up. Also, indices have gotten a little bit overbought, and we're seeing, short term, not based on traditional daily metrics, but we're seeing a percentage of stocks above their 20 and 50-day reach to the high 80s. That's important. A lot of breadth acceleration in the last month. Technology, though, in the near term is showing some evidence of trying to peak out with many of the leading stocks near key levels. A key theme, I think, based on that you want to pay attention to very closely is what's happening with 10-year Treasury yields. So if we go to that next chart, I'll just say that today, in particular, being Thursday, the 11th, we're seeing a breakout of the entire 2-month downtrend of yields from back in June, not only on the 10-year, but also the 30-year yield. This is really important because we saw a lot of correlation. If you look at this chart, you see right when this giant cup and handle pattern initially broke out back in January, which is the middle of the chart, huge base it was in Treasury yields. It broke out. That was January the 3rd. That's when stocks peaked. Yields broke out of a huge base, stocks peaked. The next area was right when yields peaked back in June. That was exactly when stocks bottomed. So there is some decent negative correlation here, or you could say positive correlation between treasuries and stocks, where if yields are going to start to turn back up, that should be a concern to people that potentially stocks might peak out in the near term. My forecast is for yields actually to get slightly back to or directly above prior peaks near 350, 360 before we roll over again. So that should coincide with at least a near-term stock market correction. My overall projection is that stocks likely move up for the year and can largely recoup a lot of what we've done and should not immediately retest the lows. But we could face some turbulence, I think, in the near term. And some of that's going to be based specifically on this catalyst of yields pushing higher.
Your last chart, by the way, Mark, was looking at commitment of traders. I wanted to bring that in as well. How does that relate to what we're seeing elsewhere?
Well, this is interesting in that it's provided some fuel to this rally only because we still remain quite negative. Now, this is a CFTC. This is non-commercial S&P futures positions. So these are the leveraged, a lot of the hedge funds. We see that even as the market has rebounded, this has actually gone more negative. So people have been selling into this rally, but we're down to the lowest levels we've seen actually since 2020. Prior to that, we're down as low as like 2015, 2016 levels. So that's just interesting to me that it seems like increasingly the investment community, particularly the institutional community, has been caught sort of flat-footed, largely for fundamental reasons on why the Fed is hiking rates and that we should be concerned of a recession. Meanwhile, all this bearish sentiment has been driving stocks up. So for me, that's an intermediate term bullish reason to stay long stocks for the second half of the year. But near term, those other charts that I presented suggest you might have a little bit of a speed bump in the near term. So, based on sentiment and cycles, I think the second half of the year is fine. Near term, I think it's a poor time to initiate new longs. I expect a pullback likely to 39.50 in the S&P. That should be a chance to actually buy dips and think that markets are going to push higher up to probably near 43.50 into the middle part of September.
We only have about 30 seconds left, Mark, but I wanted to ask you if that is the case, and that's a great thesis on how things could kind of pull back and then continue to rotate higher. Where do you look opportunistically? Is would it be a pullback, a time to get into things like technology and consumer, which have obviously had a pretty good run, but feeling very overbought, or is it areas like energy, which had been great leadership and have already pulled back quite a bit? Where would you be looking in the next couple weeks to a month?
That's a great point, Dave. Energy is one of my highlights for 2022 as being an outperforming sector. And I discussed a couple months ago why we could see a pullback in energy. I think there's one more leg down in energy. This move should be nearly complete. Once we get to the low 80s in crude, it's going to be time to overweight energy again. And my thinking is energy is the way to go. I would also buy any pullback in technology stocks. And I might add, we've seen a decent recovery in financials and also industrials in recent weeks. Those are groups that certainly have appeal also in the back half of the year, as well as healthcare, some great movement out of biotechnology. And so for near term, if you're going to be invested the next few weeks, it might be more of a defensive theme as yields go higher, maybe pharmaceuticals and this and that. But in general, I think technology should outperform the back half of the year, and that's going to be an area to favor.
I appreciate you mentioning financials, by the way. Those have been challenging charts at times, but a number of them, when I was scanning for new highs, quite a few in the financial sector. Mark, listen, it's great to see you. Thanks so much for sharing some wisdom with us. Stay safe there in New York. We'll talk to you again soon, all right?
Thank you, Dave. Likewise, be safe and have a great rest of the summer. Take care.
That's Mark Newton. Mark's the global head of technical strategy at FundStrat Global. I love how we describe that. And it's interesting how some of the comments we've had, some of the discussions we've had over the last couple of weeks, some interesting comparisons, some similarities, but also some differences. Mark talking about the potential for rates to go higher and what that would mean. I love that thinking of how the chart of the 10-year relates to the S&P, right? Lining up the peaks and the valleys there and recognizing the bottom in yields and how that was sort of the top in stocks going into January, stocks struggling as rates going higher, and all of a sudden the bottom in January or June for stocks lining up with a peak in treasury yields. You have to think about what higher rates from here could certainly do to the growth stocks that have been such a part of the story coming out of the lows from June. I did make a note, by the way. He mentioned a Fibonacci time cycle, which I hadn't thought about before. Mark throwing in a bit of a curveball with that one. I'll have to dig into that a little bit more. It's a great take, by the way, from Mark Newton at FundStrat Global. Let's continue on our show with our next segment, Shifting Stocks. What we like to do is focus on some individual names that are making headlines, that are earnings releases, or that are just showing some technical patterns that we need to check out. Let's check it out here. So going through a couple of these, let's see here. All right, so we're going to start with Amazon. And the reason why I wanted to start here is because if you look at the Russell 2000, actually, let's start at the Russell 2000 as I'm jumping around. Sorry for that. One of the things I wanted to point out was the Russell 2000 hitting the 200-day moving average. I mentioned earlier, I was talking about the S&P 500, not quite to its 200-day moving average, but getting there. The IWM, which is the Russell 2000 ETF, actually has gotten there. It's right around 200 on the IWM. What's interesting is it's reached the 200-day moving average right as it's become overbought. And I have to credit Mark Arbiter, who's a fellow CMT and a longtime technical analyst, someone I used to call on in my Bloomberg days, shared that chart with me earlier today, and I appreciate that very much. Nice run higher, but now all of a sudden we're reaching a key level. This idea of a strong run off of the lows, but hitting resistance is a theme we're going to see in other places, other parts of the market as well. So here I have the IWM hitting the 200-day as it becomes overbought. Is there enough to continue higher? Now, the technical analysis playbook would tell you this is the time when things start to pull back, at the very least on the short term. And I think it's a question of timeframes. I think my guest today, Mark Newton, did a great job of describing that sort of short-term weakness because things have had such a run, but the constructive overall environment we could see. And I think this chart sort of lines up with both of those, right? It's sort of that short-term weak, but long-term could certainly be strong given the strength that we've seen out of the lows. Markets don't usually become overbought unless they're in a bull market phase, right? In bear market phases, you don't get up to the overbought region. That's what happened with the IWM a number of times going back over the last 8 months. This is a little bit different here. Now, you can have that happen at the end of the move, which is what happened in November of last year. But this early, just after the beginning, is usually more like what you saw in late 2020 coming out of the congestion in September, October of 2020, right? See how we became overbought. And that was actually the beginning. That was in October. That was before we ran up higher for the next couple months. So could be an interesting short-term pullback within a long-term uptrend kind of pattern. That's why the chart of Amazon, I think, is so interesting. Here we have the 200-day moving average. We've reached it here. The question is there enough left to continue to power higher? Similar to the IWM, you're overbought as we reach the 200-day. The technical analysis playbook that I studied tells me to expect short-term weakness, and that's what I would have to assume on some of these names that have outperformed and have leadership up to there, but it does not tell you about the longer-term trajectory, which could certainly be stronger. Mark Newton, by the way, I mentioned financials. We haven't talked a lot about financials recently because, to be honest with you, they've sort of been lost in all of this, right? They haven't really been great charts overall. Many of them made a new low in June, and while they've rallied, not many of them have done as well as things like technology and consumer stocks, which have done much better. Here, all of a sudden, we're seeing Franklin Resources, which is ticker BEN. Look at how that has gotten above its May high. A lot of stocks had a high in June. This actually topped out in late May, but you can see that we rotated above there. It was around $27 and now holding above there, just getting above the 200-day moving average today. So once again, overbought as we reach the 200-day, but strong, breaking above previous resistance, making a new 6-month relative high today or 5-month relative high today. Holding that breakout level would be key. Holding the 200-day moving average would be even better. Now, there are other names that kind of have this similar pattern And those are a whole bucket of names that we don't have time to go through, but I encourage you to scope out. You can use our scanning engine, by the way, to look for stocks that are very close to their 200-day moving average. Could be an interesting time to see that, just to see how many of those stocks actually were able to progress through the 200-day, how many of them actually stall out here. DLB is a mid-cap name in the communication services sector. You probably heard of Dolby, but Dolby Laboratories, DLB, is a stock you might not look at too much. Basing pattern over the last 4 to 5 months, breaking out of that pattern, but now hitting the 200-day moving average. I'd be concerned about the sustainability of the move above the 200-day, but it's all about, can we break above there and can we hold it? Just to finish off here, Alphabet, right? So there are other stocks that are attempting to get out of their bases. Stock charts like DLB, like Amazon, have already broken out of their previous highs, and now we're testing further resistance. Something like Alphabet is not quite out of there. Yesterday, it closed above 120, which was encouraging. We did not get a follow-through day today. By the way, I don't know if it's technically a distribution candle. Let's look here. Yeah, so I don't know if I'd really call this a great example of a candle pattern. I was going to say this might be a bearish Harami pattern. I don't think it's that ideal of a pattern to say, pound the table and say that's a great call. It is an outside day of sorts, almost very, very close, which is where day two's range, high-low range, expands beyond day one's, but certainly showing some short-term distribution there. So I think Alphabet might be one of those examples we look back out and as an example of a stock that attempted to get out of its base but was not able to, if we see further pullback from current levels. Just to finish off, what are we looking for from these names? We're looking for them to pull a Starbucks. And what I mean by pulling a Starbucks is have a clear bottoming pattern, a clear resistance, breaking out, testing the breakout level from above, and then continuing on. Starbucks is up 1.5% today as the S&P and NASDAQ flat to down for the day. Interesting to see charts like that working when a lot of other names are not. We need to wrap the show, folks, and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1, the Russell 2000 ETF. I talked about this a little bit in my final segment about some individual names, but I did want to look at a different chart. Tells the story maybe a little bit differently. This is a chart we featured, I think, in the last week or two, but I can't remember. It's a blur. All of this rally is a blur of sorts. We have the Russell 2000 going back the last 2 years, and I want to highlight this purple dashed line, which is a trend line taking the high in November, lines up with the high in late March, also a high in early April, and all of a sudden that is where we broke out at the end of July, early August. We then continued higher and got above its previous swing high around 190. That continues that breakout pattern. Now it's the 200-day. We traded up to the 200-day today, which is also at a big round number of $200 and sold off from that level. Can small caps get above that level? Small cap leadership, I would argue, probably a key part of the bullish thesis from here. Certainly outperformed in the last 4 to 6 weeks. I'd be keen to see if that can break above the 200-day moving average. Chart number 2 is looking at breadth. My guest today, Mark Newton, mentioned breadth and particularly mentioned this green data series at the bottom. This is the percent of S&P names above their 50-day moving average. About 2 months ago, mid-June, this was in single digits, just below 5%. Now, 2 months later, it's just above 85%. Talk about a change where four stocks out of every 5 in the S&P 500, a full 400 plus names, were below their 50-day in mid-June, now above their 50-day in mid-August. That is a big swing. Now, if you go back the last 25 years, this going back to the late 90s, how many times we've gone from single digits up into the 80s, it's minimal. There are actually very few, if any, observations. At a quick glance, I saw very few that were even close to that. So in some ways, pun intended, we're in uncharted waters where you've had such a rally. I would say, generally speaking, you don't get this high except in bull market phases, right? For that many stocks being an uptrend, it really has to be a broad advance, which tells me the weight of the evidence for the longer term, for the medium term, certainly starting to improve a little bit. In the short term, this tells me to be a little concerned about the fact that so many stocks have had such a run in a compressed period of time. Finally, the financial sector. Talk about a beautiful illustration of the power of basing patterns. The XLF had about a 14% range from the high in January 2022 to the neckline that goes back through 2021 to early 2022. When we finally broke that in April, the simple measurement technique, taking the height of that base and subtracting it from the neckline, gives you a downside objective right about there. That's where we hit in June. We're now testing resistance from below. Can we eclipse that? That's a question mark in my mind. Folks, that's a wrap for the show. Special thank you to Mark Newton from FundStrat Global Advisors joining us from New York. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.